Okay, welcome to the presentation, everybody. My name is Clay Malcolm over at New Direction IRA, and today we're going to be talking about self-directed IRAs that are investing in real estate investments, but in a little bit different way. You know, I was talking to some of the folks over at Wilshire Financial Partners, and they said that they would be glad to, let people in on some of the criteria that they use for real estate investing and some of the things that they've learned. And Don Pelgrim, the CEO over at Wilshire Financial Partners, was nice enough to volunteer his time. So he's going to be our main speaker today. I'm going to run through a little bit of self-directed IRA information here at the beginning, and then Don will be taking the presentation from there. A couple quick things. If you have questions about any of the content, please feel free to type them in the questions box in your console, and we'll answer them at the end. So as they come up, just go ahead and type them in, and we'll see if we can knock all those out after the presentation part. The other thing you'll notice is that there is a handout in your console that you can download, and it's really just a self-directed IRA primer. So if you have questions about how self-directed IRAs work, what some of the key rules are and things like that, those are covered in that short little guide. So with that being said, let's go ahead and get started. And first thing I'll start out with is all the information today is going to be for educational purposes only. At New Direction, we don't give any tax, legal, or investment advice. We don't endorse any type of investment strategy or investment vendor. And we certainly encourage you to talk to your financial team and your real estate team anytime that you're considering an investment for your IRA. Our job in the equation is really to just make sure that your assets that your IRA buys and sells are documented properly so that you get to keep the tax benefits that are associated with the account type. And most disclaimers are a little bit of a, let's get through this because it's not terribly informative. But the fact of the matter is, when it comes to self-directed IRAs, they are a different paradigm for a lot of investors. And I would say that the disclaimer in this case means that the account holder needs to know that they are going to be the person who performs the due diligence and also the person who makes all the investment decisions, along with your financial team, of course. But it is a more active type of investing. And the cool thing is that you can get into all kinds of assets that you might not otherwise be able to get into. So alternative assets, private equity, a lot of things that your normal IRA at a bank or brokerage house wouldn't be able to access. So you get to use your expertise and your creativity and invest and make money for your retirement. So self-directed, the term often gets misused, and I'll just clear that up a little bit if I can. So self-directed, all that really means is that it's a marketing term. It's not an account type with the IRS or a legal distinction. It's really just indicates that the account holder is going to have an active role in choosing the assets that money buys. So in the generic paradigm of these accounts, you make contributions. That money is then being held in trust for you at the IRA provider, and it's going to invest in some things, and it has tax advantages that are associated with the account type. And so your job is to get that money to invest in the things that are going to be the best match for your financial situation. So your risk tolerance, the returns, the timing, all that kind of thing. So if self-directed is not an account type, what are the account types? Well, they're the ones that you already know. So traditional IRA, Roth IRA, and a lot of people are unfamiliar with the fact that health savings accounts are also individual custodial accounts, and they do persist through time. They're not like flex spending accounts where they're use it or lose it, or health reimbursement accounts, which are controlled by your employer. Once you have an HSA, it is actually an individual custodial account, and its investment procedure is very similar to a traditional or Roth, even though its tax advantages are different. And then if you have employer plans like a SEP or a Simple or a solo 401k, all of those can also be invested in any of the assets that the provider offers. So one of the things some people don't know is that the IRS does not dictate to IRA providers which assets that they handle. So banks and brokerage houses will do the custodial part of your IRA, but when they do that, that IRA at their particular in their business model can only invest in the things that they sell. Whereas the business model for self-directed IRAs that handle alternative assets is you choose the account type. We make sure that the bookkeeping and the custodial part is taken care of, so you get to keep the tax advantages, but you make all of the decisions, and you're able to invest in publicly traded securities, but also private assets like real estate, lending, private equity, that kind of thing. So it's any of these account types can actually be doing the investing that we're going to be talking about in the presentation today. So if you have any of these, or even old 401ks or 403bs, defined pension plans, defined benefit plans, any of those kinds of things where you're no longer employed at an employer, they can usually be rolled over into one of these account types and invested in the way that we're going to talk about today. One of the interesting things about, I've been in this business for about 7 years now, and one of the interesting things is that people will say, well, I would like my IRA to be invested in real estate because of its unique characteristics as an asset class. But that's actually only the beginning of the conversation. So just to be clear, an IRA can hold title to real estate, and it can do that with or without debt. So it can be on title. It can be a partner entity in an ownership. So it could be one of 5 or 6 or 10 owners on a particular property. But a lot more people are interested in the two bottom boxes there, which is lending in some way that is collateralized by real estate, or investing in an entity that is then going to invest in real estate. So it's very common for people to create an LLC or some sort of entity, gather investors there, and then go out and execute their real estate initiative through the LLC. And the lending part is kind of the same idea, is that the IRA can participate in a real estate deal, but not necessarily be on title. So again, saying that you want your IRA in real estate is a great start, but it's not the end of the conversation, because you need to think about, okay, what types of characteristics am I looking for in my investment? And again, timing and all those types of things play into it, because IRAs, of course, are only part of your overall financial picture. But one of the conversations that I get into a lot with our account holders is, well, how much time do you want to spend, and what's your risk tolerance, and what's the potential worst outcome? So analyses like that, which of course usually they end up taking up with their CPA or their attorney or the rest of their financial team. But we often start that conversation with, hey, these are all things that play into which type of real estate investing you're going to do. And the time one is really an interesting one, because most people have, especially people my age and older, have grown up thinking that IRAs and 401ks are very passive. And when you're in a self-directed environment, so whether it's, again, whatever account type it is, if you're the one pulling the trigger and doing the due diligence and deciding when to buy and when to sell and all that kind of thing, it's much more active. So to some extent, one of the criteria is how much time do you want to spend at it. You can make real estate investing in your self-directed IRA very passive, or you can make it very active. So that's one of the criteria that I hear our account holders talk about often. So do you want to buy and manage a property? If you do, how are you going to handle the management? Do you want to kind of do a do-it-yourself thing or not? Do you want to be a lender? Is that a better setup for you, or be some type of equity investor? So all of these, again, can be real estate based investments, but they all have different properties. And Don's going to go into some of the ways that constellation of criteria can be analyzed, so that you can have a better sense of how you want to put it together for yourself. But you can see that more time is do it yourself, and then medium might be turnkey service providers and things like that. But that last one there, being money provider, is usually the lender or equity, and that's typically the less time. And in some cases, it has other very attractive qualities as well. Again, because we don't give any tax, legal, or investment advice, that's kind of where I have to stop in terms of my expertise. And that's why it was nice that Don was able to take some time out of his schedule to talk more specifically about the criteria that are generated or that are analyzed for any particular type of investment. Now, in terms of the mechanics, a lot of people hear about self-directed IRAs and they think, well, it could be, this is a really tough thing to do, or it takes a long time. And it's really pretty easy. It's just 3 steps. So you set up an account at a self-directed IRA provider like us. Then you do a transfer or a rollover or a contribution or some combination of those. So you have the account open, and then you put some money in it. With us, that cash is FDIC insured in a bank, waiting for you to choose an investment and execute those documents. We help you with that, obviously. And then you go out and you find your investment. You acquire those assets, and we help you with the paperwork for that. And like I say, the opportunities that you have in terms of the asset class or even the type of ownership are really pretty broad. So using your expertise and your sense of judgment and what you think is best for your financial world is really the be all and end all of how that account moves about. You're making those decisions. And here's our contact information. Don hasn't had a chance to speak, but I'm going to turn the presentation over to him at this point. But I do know that he's willing to, as well as I, hang out at the end of the presentation to do Q&A, and also for further inquiry, please feel free to visit our websites or contact us if you have any follow-up questions, because a lot of times putting these pieces together takes a little bit of time to digest and that kind of thing. So we're happy to help you along. Don, are you at the mic there? I'm going to go ahead and change the screen over.
I am here.
All right.
Give that a shot.
Yep. Hey, thanks a lot for spending some time with everybody today, and I will turn the presentation over to you.
Thank you, Clay. That was a terrific lead-in. Can you see my my screen okay?
I still have blue.
Let me give this another shot here. Let me try to move this over this way.
Oh, there you are.
Are you seeing the screen now?
I am. I'm seeing it in presentation mode.
There we go.
There it is. Yeah, so
perfect.
Again, everybody, Don Pelgrim of Wilshire Financial Partners, CEO, and Don, take it away.
Thanks again, Clay. Well, good morning, everybody. Thank you, and welcome to our presentation on private debt investments and investing in trust deeds and real estate secured debt investments. As Clay said, I'm Don Pelgrim, and I'll be taking over the presentation from here. In terms of housekeeping, Clay has already covered a little bit of this, but this presentation is for educational purposes. It's a summary only, and we will cover a lot of the larger topics or the larger questions, but we're not going to cover everything in this presentation due to the time constraints. We're not providing investment advice. We're not offering to buy or sell securities. And real estate investments do involve some risk of loss. So it's important that you investigate and review the risks prior to investing. We're also going to be talking about some historical performance, and past performance is not indicative of future results. Further, we're going to cover some forward-looking statements, and those forward-looking statements are subject to change. And as Clay mentioned, both of us are encouraging you to seek the advice of experienced professionals before you invest in any asset class, really. So our agenda today is we're going to be discussing private debt investments, and we're going to define what they are. And then we're going to be talking about differences in certain real estate secured loans, and we'll cover the benefits and risks of real estate debt investments. And then we'll cover some of the next steps that you as investors should take when evaluating this particular asset class for potential investment. But I'm going to start out by saying in describing who Wilshire Finance Partners is. We were formed in 2008, and we are a boutique real estate investment firm that provides an institutional approach to investing. Among different disciplines in our firm, we have people that have real estate finance experience, banking experience, legal experience, accounting, and other experience. And our focus is on short-term fixed income investments that are real estate secured, specifically real estate secured private debt. As Clay mentioned, I'm the CEO of Wilshire Finance Partners. I'm also the fund manager. I'm an attorney, and I'm a former banker. So over the last 30 years, I've been financing real estate and representing lenders who finance real estate. So that's my background. Wilshire's platform covers the core investment types that we're going to focus on today. So that includes individual loan investments as well as real estate debt funds. We operate two funds, our WFP Income Fund and our WFP Opportunity Fund. And to give you some context, our funds are up on various different investment platforms, including Fidelity, Pershing, TD Ameritrade, Wells Fargo Advisors, and New Direction IRA. So let's talk about private debt investments. First of all of the investments that are listed on the screen are securities. But let's define those securities a little bit further by describing private debt versus public debt. Now, public debt is the debt that's accumulated by government agencies. So those might be your municipal bonds, for example. Private debt is the debt that's accumulated by individuals or private businesses. Now, some debt is registered and some debt is unregistered. Registered securities are securities that are registered with the Securities Exchange Commission under the Securities Act of 1933. And some of those registered securities are also exchange-traded securities. You can trade them across a bond exchange, for example, and those are registered under the Exchange Act of 1934. Some securities, though, some debt securities are exempt from registration, and there's really two core types of exemption. Some securities are exempt from registration because of the type of debt that it is. That might be, for example, a certificate of deposit. Other securities are exempt from registration because of how they are sold, and that's called a transaction exemption. So a good example of a transaction exemption is a private placement where debt is being offered off of the exchanges in a private setting. If we drill down a little bit further, you've got secured and unsecured debt. And unsecured private debt includes working capital lines, unsecured lines of credit, and similar forms of debt. Secured debt includes accounts receivable financing, equipment financing, real estate financing, and other forms of secured debt. So when we talk about real estate secured debt, taking it another step further, real estate secured debt can also be a first lien, it could be a second lien, a third lien, it could be mezzanine debt or other forms of debt. So in today's presentation, what we're going to focus on is private exempt real estate secured debt, specifically first liens, and we're going to use a shorthand for that. We're going to call them trust deeds, or we're going to describe that as trust deed investing or private mortgage investing. So what exactly is a trust deed? Well, each state adopts its own method for dealing with mortgaged or encumbered properties. Under states that follow a lien theory, the security instrument creates a lien on the property, but the borrower still holds title to the property. Those are mortgages. Under a title theory, there's a security instrument that transfers title to a trustee who holds title to the property until the loan is paid in full. That's a trust deed state. So the trustee has the power of sale if the borrower defaults. So the main difference between a mortgage or a deed of trust is how you have the ability to foreclose on a property if a borrower is not paying you. Again, a lien theory or a mortgage state, you would have something called judicial foreclosure, which means that you would need to file a lawsuit for breach of contract on the debt and sue the borrower for the collection of that debt. Under a title theory or deed of trust state, you have the option to use something called non-judicial foreclosure. And that's an accelerated foreclosure process under statute and allows you to go through something called a trustee sale. And that's an accelerated process by statute. Now, the difference between holding a mortgage or holding a deed of trust could be significant in terms of holding time and cost. And trust deeds generally are a little bit more quick and a little bit less costly to foreclose on a property if you have to go down that path. So the takeaway here, when we're looking at the type of debt investment, is that the state that you're lending in or the state that you're investing in and the type of security instrument does matter. So with that as our backdrop, let's talk about some of the benefits of investing in trust deeds. Well, the first benefit is that you get to be the bank. And I want you to imagine that if at the end of the month, somebody is sitting at their desk and they're writing a check to make their mortgage payment. Now, I then want you to imagine that you are the bank and you're actually receiving those payments. So the basic premise of investing in trust deeds is that you start to receive that monthly cash flow from the interest payments or the mortgage payments that are being made every month by the borrowers. So some of the the benefits of investing in trust deeds would be potentially higher predictable returns. For example, in our funds, we've been able to generate in our income fund about a 7% annualized return to our investors with monthly cash flow, and that comes through the interest payments that come from underneath those loans. In our more aggressive fund, the returns have actually exceeded 10%, and again, coming from the cash flows of the underlying investments. When we talk about cash flow, that comes from the monthly interest payments or the monthly checks that the borrowers are selling in to make their mortgage payments, or from the dividends that derive from those monthly mortgage payments in a fund context. So that creates a little bit more consistent monthly cash flow for the investors investing in the instrument. These types of loans tend to be a little bit shorter in term, 1 to 3 years in term, as opposed to 30 years that you'll see on exchange-traded bonds, for example, CMBS or RMBS securities. Again, we're talking about a private, exempt, non-traded security, so these trust deeds are not correlated to the stock or bond markets. In other words, there's no exchange risk, there's no market risk or volatility associated with what might be happening on the stock or bond markets. Now that differs from real estate market risk or transaction risk associated with real estate, but you don't have the same volatility that you'd see in the stock or bond markets. You also don't have the same sensitivity to interest rates if you hold these loans to maturity. The loans are backed by a hard asset. They're backed by real estate. So as compared to other forms of debt, such as corporate bonds in a distressed situation, for example, a company's bankruptcy, might be valueless. But most forms of real estate will have value that's north of zero, even in a distressed situation. Now, I say most real estate because there's actually been times where there is negative value. For example, if somebody is speculating in land where the cost of the entitlements or future development exceed the developed value, then you can have some negative value in that real estate. But as comparing that to maybe a multi-tenant office building that has tenants in place, and you've got the sticks and bricks that are already in the ground, the theoretical value of that building is going to be something north of zero. So it's different as compared to, say, an unsecured corporate bond. And what that does is it provides some protection from downside risk. And the key there is the protective equity cushion, and we'll be talking about that and how that operates a little bit later. It's not a very complex investment. As we said, you're making loans and you're receiving the cash flow from the loans. So it's pretty easy to understand. As we get into this, you'll see, though, that some of the devil is in the details, like most other types of investments. And it certainly is a portfolio diversifier. It gives you the capability to have that non-correlation, which provides a hedge for your investment portfolio. So some of the benefits of investing in individual loans versus a fund would be that if you're investing in individual loans, you have the capability to self-select the loans that you want to invest in. I'm going to invest in loan A, but I don't want to invest in loans B and C. And that creates more control for the experienced investors in this space. And it may also lower the cost if you're servicing your own loans. Fund investments, on the other hand, will provide the investor with professional management, and we'll address that a little bit further down the road here when we talk about risks. You have the capability to further lower your risk through diversification in a fund. And the theory there is that unless you're investing millions of dollars in this type of investment, you may only invest in a single trust deed or a few trustees, and therefore you have a concentration of risk, perhaps, in a single loan. Therefore, you wouldn't achieve the same level of diversification or risk mitigation that you might have in a fund. You also have the ability to more efficiently deploy your capital. For example, if you're investing in an individual loan, or you want to invest in individual loans, but you're sitting on the sidelines while you look for loans, or after your first investment, that loan pays off and you're waiting for that next investment to come through the door, that will impact your returns. In a fund that's very active, making loans, having loans repay, or making new loans, your capital is going to be more efficiently deployed, and that will increase your overall returns. A fund can also give you greater liquidity, as opposed to holding an individual loan to maturity or attempting to sell it in a private market. Again, these are not exchange traded. You may have more liquidity in a fund that has internal liquidity as loans pay off. And the last piece here, which is very important for the context of this presentation, is that you have the ability to get compound interest. And that's very important for people who are investing through self-directed IRAs or 401ks or other self-directed accounts. Because again, unless you've got lots of money invested in this space, it would be very tough to take that monthly incremental income and reinvest it into real estate loans, because real estate loans tend to be a little bit larger. So investing in a fund gives you that capability to invest in getting compound interest. So the takeaways then become that some of the benefits are you can get higher returns, you're able to get monthly cash flow, you're not correlated to the market, so you've got a hedge, you're backed by real estate, and you've got a protective equity cushion. And there are some different benefits investing in loans versus a fund, one being control, others being diversification. So let's talk a little bit about the risks then. What is the primary risk of investing in this asset class? Well, the primary risk of any lending is the risk of not getting repaid. So as an investor in this sector, you have to think about the risk approach. And when you think about the risk approach, it's about risk mitigation. So when we think about that, there are going to be certain risks that you're going to accept. If you look at the very right-hand side of that, the inherent risk of investing in certain investments is something that you're going to be taking on, and you accept that because you're anticipating getting a return. Conversely, there's going to be certain risks that you're going to avoid and you're going to walk away from. For example, lending to somebody who's a criminal might be something that you don't want to do because of the risk of non-payment or the risk of trying to collect that payment. There are risks that you'll transfer. A good example of that is the use of insurance. And in real estate, you'll have hazard insurance to protect against fire. You'll have general liability insurance to protect against a slip and fall. And you've got title insurance to ensure that you've got good title and you're holding your lien in a first position against that property. And then there are going to be risks that you're going to mitigate. And that's where a good lender or a fund manager will provide a lot of benefit to you, is how they go about mitigating the risks of this particular asset class. So when we talk about risk mitigation, we talk about two fundamental concepts. And the first concept is the probability of default, and that is the likelihood that a default would occur on a particular loan that's being made. And the second concept is the loss given default. In other words, what is your loss exposure if there is a default on a particular loan? What do you have at risk? Now, lenders approach those different risks in different ways, fundamentally in terms of how they view lending. Traditional lenders use what they call a credit-based approach, and they look at the 5 C's of credit, which are character, credit, capacity, cash flow, and collateral. Now, credit is a historical review of the borrower's credit history, and that's supposed to be a forward predictor of how they're going to manage their loan and manage their credit on a move-forward basis. The character kind of leverages off of that. It's how the borrower worked with their other lenders, and do you get a sense that the borrower is going to repay you as agreed? Capacity is the borrower's outside income or assets, and whether that income or those assets are sufficient to cover any cash flow shortfall from the property in order to warrant maybe a higher loan amount that's being made by the lender. Cash flow is the actual cash flow or net cash flow, net operating income from the property, and whether that cash flow apart from the capacity of the borrower is sufficient to service the monthly loan payment. And then the collateral is the actual real estate. What is the value of that collateral? What is its marketability? What is its condition? So with a credit-based lender, the credit-based lender typically will justify a higher loan to value through credit underwriting by looking at certain things like the credit and the capacity of the borrower. Where a collateral-based lender will require the borrower to have more equity, and they're going to be relying more on the cash flow and the collateral itself, seeking to have a greater protective equity cushion. And the logic behind that is that you might have a borrower with excellent credit, great character, and good capacity, but what if they step off the curb and get hit by a bus? Well, instantly, you no longer have that character, that credit, or that capacity, so you're relying on the cash flow. And a collateral-based lender looks at that and says, well, I prefer to have the cash flow and prefer to have a lower loan to value because I want to look to the property as my source of repayment. So how does the protective equity cushion work actually in terms of numbers to create that buffer, to create that assistance to protect you against downside risk? So let's assume you've got a property that's got an original value of $1 million, and you're comfortable lending 65% of that property's value. So you're going to make a loan of $650,000, which means that the borrower will need to have $350,000 in equity in the property. But what happens if there's a 20% drop in property values? So that property is now worth $800,000, there's a $200,000 loss in value. Well, the borrower is not feeling very good because they just lost 20% of the value of their property. But what about the lender? What about the person that's holding that $650,000 loan? How much principal have you lost? Well, you haven't lost anything, right? Because again, you've got a property that's worth $800,000 and you've got a lien against that property of $600,000, and you've got a borrower with $150,000 remaining as protective equity. So let's take that a step further. Let's say you've got that same scenario and you've got that $200,000 loss in value, and then the borrower defaults. The borrower doesn't pay you. Again, what have you lost here? Well, the key here is that you still have some downside risk protection, and you've got downside risk protection because the borrower actually has skin in the game. And by having that additional equity or cash in the property, the borrower's got something to lose. So the borrower's more motivated to make sure that that lender gets repaid. It's also that buffer against a decline in property values. And borrowers that have some equity in their property find it easier to either sell that property or refinance that property, which again helps the lender get repaid. So when you think of the protective equity cushion, it helps to reduce the probability of default. In other words, the borrower is going to be more apt to repay you, and it reduces the loss given default or your loss exposure because you've got a protective equity cushion or a buffer before you start to erode your loan. So again, the protective equity cushion, the takeaway is that it reduces risks of probability and loss because the borrowers have skin in the game. Now, all loan investments, all trusting investments are not equal. There are a number of other factors that you'll need to consider. So for example, transaction type. Somebody who's purchasing a property and bringing in cash will have a different risk profile than somebody who is cashing out of a property, getting a cash out refinance. What drives the transaction will also affect the risk profile. Is it a short-term bridge loan? Is somebody going in and fixing and flipping a property? Is that property being stabilized? Is it part of a 1031 exchange and the borrower just needs speed? Or are there other transaction attributes that would affect the risk profile? Property types will also affect the risk profile. I mentioned land and acquisition and development and construction a little bit earlier, but even in that category, do you have raw land? Do you have entitled land? Do you have blue top lots? Is it track construction? Is it infill construction? If you're looking at existing properties, single-family homes, multifamily properties, and commercial real estate also have different attributes. And you need to get into your valuation determination, including who's doing the valuations and the valuation methodology that they may employ, as well as getting into your borrowers and your sponsorship and title review, legal review, and other factors. But I want to dig into one of the factors here and just make it just a little bit of a deeper dive so you have a better understanding of what we're talking about in terms of not all loans not being created equal and all risks not being created equal. Now, when we looked at the protective equity cushion, what was the single factor in the protective equity cushion analysis that was the most critical? Well, it was the initial value, right? It was your starting point. It was that initial value, and if you're off on that number, it's going to impact your protective equity cushion. So the key questions there would be, what is the value that's being used? Is it the current as-is value of the property, or is it some future value or some after renovated value of the property? And what method was used to determine the value? Was the valuation requested by the lender on a single-family home based on a sales comparison approach, which may be the most appropriate, but was it the sales comparison based on how that property sits today, or again, on that future value? With a multi-tenant office building or apartments, the income approach, in other words, the net operating income of that property, might be the most appropriate method to determine that property's value. Comparing that to a warehouse or industrial building with an operating company, it would be important to separate out the enterprise value of the operating business from the real estate value. And you may want to see what the go dark value of the property would be. In other words, if the business shuts down or goes dark, what is the value of the real estate worth at that point, separate and apart from that operating company? And then the last question is, who's determining value and what is the methodology they're using? Are they using a single approach, or are they using multiple approaches to determine value? So let's take a look at the potential impact of how value works, or how the methodology works, and the impact on the risk of your loan. And here we're going to be looking at the as-is value of the property versus the after renovated value of the property. So let's say you've got a property that's worth $800,000 as it sits today, as is. And again, using our theory that we're going to lend 65% against that as-is value, we would make a loan of $520,000, which means that our borrower would need to bring in $280,000 in cash equity. But if you're looking at the after renovated value, and you've got an after renovated or an anticipated value of $1 million, and you're lending 65% against that value, well, your loan amount goes up to $650,000, and the borrower is only needing to bring in $150,000. Remember, they're acquiring that property for $800,000. You're financing the bulk of that, and the anticipated future value is that $200,000. So in effect, you're not lending 65% against the as-is value. You're really lending more like 81.25% against that as-is value. And the risk associated with that are certain things. For example, would they complete the project on time and on budget? Will the market still support the projected value when the project's completed and they're ready to sell? In other words, will real estate values continue to climb at the same volume and velocity that they are today, or will they moderate, and will that affect the future value of that property? You'll have a higher loan amount relative to the current value, and that means that the borrower has lower relative equity relevant to the current value as well. So if there's a change in circumstance, they're not able to get that project completed, or the market doesn't work in their favor, what does that do to your protective equity cushion? Similar analysis. Let's say we're looking at a borrower that already owns the property, and they're looking to get a cash out refinance. So the borrower originally purchases the property for $500,000. That's their purchase price. And then they put additional capital into the property. They put some carpet and paint and some other renovations into it for about $50,000. So their cost basis in the property is now $550,000. They come to you a couple of months later. Let's say they come to you 3 months later, and they say, you know what, I want to go ahead and get a $552,000 loan based on a 65% loan to value on the $850,000 value I think the property's worth today. So you go ahead and you make that loan of $552,500. In effect, you've fully cashed out the borrower. So it's kind of like the borrower going to Vegas a little bit and now playing with the house's money. If real estate values later decline, does the borrower really have any real skin in the game or real equity in the game? Remember, they've taken most of their chips off the table at that point. So there's a number of different scenarios like this where you start to look at values, and you have to dig a little bit deeper to determine what the motivation is and what's occurring there so that you can assess the risk. So for the investor, the key takeaways here are what value is being used and what is the method that's being used to determine that value. Just as importantly, who's determining that value? Is that being done internally, or is that being done by some third parties? Is it a combination of both? And then lastly, the critical question there is, at the end of the day, does the borrower really have any skin in the game? Do they have something at risk? Do they have something to lose? And that's what's important about the protective equity cushion. Now, I want to drill down into another one of the attributes here, and that's pricing and assumption of risk. And I want to sort of describe this a little bit and see how it impacts the actual and perceived risk of a loan. So the theory here is that if you've got a borrower that is willing to pay 10% on a loan, and that being market, and again, these are just examples only for ease of numbers, versus a borrower that's willing to pay 14%, well, theoretically, the borrower that's willing to pay 14% probably has a little more risk associated with that particular investment. So let's assume that you've got a balanced approach. You've got a borrower that's willing to accept 10% in all-in costs. In other words, the total cost of financing might be an 8% note rate, and that note rate is the interest that's being passed through to the trusted investor, and they're willing to pay a 2% origination fee on a one-year loan. Well, the all-in cost to the borrower is 10%, and that 2% origination fee might be retained by the promoter or the mortgage broker or mortgage banker making that loan and ultimately selling that loan to the investor. Now, after all, they've got to make a profit, so they're keeping themselves in beer and chips, so they're keeping that 2% origination fee, and they're passing along that 8% to the trusted investor. Moving along the spectrum, you've got a situation here where you might be a little bit fee heavy, right? In the middle column there, you've got that same all-in cost to the borrower of 10%, and the borrower is indifferent, right? Because the total cost to them between the fees and the rate, their effective cost of capital is still 10%. However, in this scenario, the note rate being passed through to the investor drops to 6%, and there's a 4% origination fee being retained by the promoter or the person that's selling the loan. Therefore, there's a 2% reduction in the return to the investor just based on how the loan was priced and how the cash flow from that loan is being distributed. Now, this last scenario, where you've got a 14% all-in cost to the borrower and a very different split, is something that I've heard recently, and kind of scratching my head on why the investor, the trusting investor, is allowing this to occur. But in some instances, the borrower was paying 14% all-in cost, right? So much higher risk theoretically as compared to that 10% loan. And the note investor, the trusting investor, was getting a 7% pass-through rate, and the originator or the promoter was getting 7 points. They were getting 7% on the loan that was being made. Remember that when the trusted investor is holding the loan and investing in the loan, they're holding all the risk of default. So in my view, when we start to look at heavy fees versus the pass-through rate, or a real misalignment of the issues, it looks like there's a misalignment of the risk and assumption of risk that an investor would be taking in those trust deeds. So the takeaway on this particular slide is that you want to understand the risk-based pricing model that's being used and understand how the fees and costs are being attributed and who's retaining different portions of the income. And the goal there is to ensure that there's an alignment of interest between the person that might be originating that loan and selling that loan off, and the person who's holding that loan in their portfolio as an income-generating vehicle. So we touched on just a few things here, and I apologize, we ran through that very, very quickly, but the bottom line here is when you start to look at this investment class, you start with who you are purchasing these investments from. You need to look at the fund manager, or you need to look at the seller of the individual investment. And I believe you need to look at their training. You have to understand their licensing. Are they properly licensed to be able to do this? What is their experience, including potential workout and foreclosure experience? How many real estate cycles have they been through? Were they doing something else a few years ago, or have they been through a few cycles as a lender and have that experience both in up and down cycles? What is the platform and structure that they're using? Do they put their money at risk, or is it just your money that's at risk? Is everything done in-house? Everything done in-house is not good or bad. It could be good, it could be bad. Remember the Bernie Madoff situation, where Bernie had everything happening in-house and was sending out ginned up statements. So having checks and balances in place might be beneficial just to look at who your counterparty is. Do they have a third-party fund administrator? Do they have a third-party servicing agent? And are they independently audited in terms of how they're conducting their business? Is there post-investment support? Is there portfolio management and servicing? Is there administration and assistance? Or once you purchase the investment, you're on your own. You take 100% of the risk with no additional support. Then you get to their underwriting and investment philosophy, and it goes beyond the valuation and pricing that we were talking about. How are they identifying and addressing the risk of the underlying investment? And more importantly, how they go about that is determining how they're going to take steps to protect your individual investment. We talked about the alignment of risk and reward, or the pricing and assumption of risk. You want to make sure that there's alignment. Do they have some skin in the game along with you? And then once you get past that, I believe you start to look at the individual loan types and the individual investments and how they're approaching the market and how they're underwriting those loans. So that upfront due diligence on your counterparties and who you're doing business with is just as important as looking at those underlying loans. So with that, again, this was a brief overview, and undoubtedly there are going to be a number of questions and comments. And regardless if you're new to private debt investing or you're a grizzled veteran and have done this for many years, I invite you to contact me with any questions or comments, whether that's today or after the conference. You've got my contact information on the screen. So with that, Clay, I'd like to open it up for questions.
Great. Yeah, and I just in case everybody needs to take off and get about the rest of their day, thanks a lot for joining us. And Don and I will hang out for questions a little bit, but if it's time for you to leave for the day, thanks for joining us. So let me